There we go. Guten Morgen. It is 6:33 on Wall Street, 3 hours before the open of trading. Welcome to QuantBox Live. It's time to get our global macro on, where we uncover the best fundamental investment opportunities across the board. It's actually investment and trading because we've upgraded QuantBox. I've only sent out emails about 6 upgrades. There's probably another 6 that I haven't even had time to tell you about. But, anyways, the big difference now is the investment opportunities are longer term. That's the quantitative analysis of economic data like GDP and inflation, all that kind of stuff. But QuantBox has now added more market data where it's looking at VIX, the S&P 500, yen futures, gold, S&P 500, like it's watching it all in real time to therefore help you uncover trades as well as investment opportunities. What is the market doing right now versus what quote unquote should the market be doing? But anyway, so QuantBox is unbelievable. So, anyways, my name is Wayne McDonald. I am a classically trained economist. I actually have an education in our subject matter, but also I've been trading for 20 years. And before that, I was a venture capitalist. So back then, I was simply an investor. So we're taking both these things, the trading and investing worlds, and trying to combine them into something beautiful. Right? Or at least we're trying our best. So anyway, so we take a look and we automate. So think about this, like what is QuantBox going to do for you? Well, mechanically, let's say, or technically, what it's going to do is automate your research so that you have the same information as a trader at Goldman Sachs or JP Morgan or at some big billion-dollar hedge fund. Instead of hiring a quant for $250,000 a year, QuantBox does that kind of research for you. On the soft side of it, because you have research and you're making better decisions and you know why you're placing trades, not just because MACD told you so, perhaps it'll give you the confidence to let your winners run. So anyway, swing on by quantbox.co. If you're watching this on YouTube, you're watching a video that is delayed. Let me get rid of that TV here. You're watching a version that is delayed. Why don't you swing by QuantBox and take a trial? Yeah, take a trial. It's $8. That being said, let's get on with it. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. And that idea of letting your winners run, I suppose I don't have it open anymore. Let me bring this back. I was actually looking at, let me get in here. I was actually looking at seasonality for the yield on the 10-year T-note because I'm actually exposed to some risk on the 20-year Treasury market. And I'm asking myself, okay, yields are very high right now. And QuantBox says they shall likely continue, or at least they are very high. That's it. That's what QuantBox is saying. They are very high, and it's, well, expected to be very, very high. All right, cool. So my question is, well, what about the near future? And they tend to kind of level off this time of year. And this spike, well, is actually not that unusual. So the thing is, if I'm exposed to this risk, do I bail or do I stick it out? Well, now instead of making an emotional decision, I'm making an intelligent decision. So anyway, so I appreciated this. All right, so let's get on with it. Let's go to the dashboard and look at the wow. Look at this scatter chart, the scatter plot. What does that tell you? Positive slope, negative slope? Yeah, negative. Yeah, you can, right? You can see very, very clearly. Looks something like that, huh? Yeah, and the trend, what you do is, when I say positive negative slope, what we're talking about is rise over run, and that's a negative number. It's falling. Yeah. So very interesting. That's what's going on now, but this is nearly real time. So what we're trying to figure out is what's going to happen the rest of the day. Eh, eh, Proceed. Okay. Now we still on the medium and longer term, we're going into this new trading week, still with some vulnerability from last week and just the ever slightest tick to the upside. Now, when I woke up this morning and just so you know, just to paint a beautiful picture, I listened to Bloomberg television while I'm showering. And when I'm nay nay. So anyway, so I'm listening to Bloomberg and they're like, oh my God, it's the end of the world. Uade has said that he might change their policy and get rid of negative interest rates. It was like the biggest thing, like it was the end of the world, like the Japanese yen had just skyrocketed. And I'm like, huh, that's interesting. I talked about that yesterday and in the Asian session, and it didn't seem to be that big of a deal. So I was really worried. And they're like, it gapped down, it gapped down. And I'm like, oh my God. I was ready to like run to my charts. And I'm like, support held. like no big deal at all. But thank you, Bloomberg, for the hype. Don't believe the hype. So, anyways, yeah, okay. But look, QuantBox is saying on the medium term, yeah, you should be bullish yen for sure. On the little bit longer term, yeah, you should be bullish yen. Yeah, you should be. And then as far as right now, post this news, no, not so much. Seems like maybe prices come down and bounce. But anyways, let's take a look at if the world is freaking out because Bloomberg's freaking out. So I look at it and I'm like, well, Dixie barely moved at all. Dixie is actually down a little bit. That's slightly risk on. Hmm. The yield on the 10-year hasn't changed at all. The S&P 500 is slightly up. That's I'm like not much. Like it still gets a score of 0, but it's not crashing. Maybe it'll crash at the open. Who knows? Gold is up slightly. Yen futures are, yeah, look, they are up. Sure. And then VIX, hardly anything. VIX right now is up 2.47. That's not a big deal for VIX. And remember, a VIX going up is bad. Okay, weekly. Hmm. Hmm. But monthly, VIX is down. Like, huh. It still feels to me, and maybe I'm reading into this, and this is a risk all traders and investors face. I feel like we're in a transitionary period. And when I look at this, like the VIX, what is the VIX? This is professional investors buying insurance on um, their their stock market positions, in particular the S&P 500. But I don't know if it's actually that particular anymore. This shows you are they hedging or not. That's really it. Hedging is an insurance, right? And so you look like, well, over the month, there's actually less hedging going on. Okay. So I'm like, huh. So, anyways, let's move on with it. Yeah, okay. COT report. This was interesting. How many people did the commitment of traders report over the weekend? I hope you did. Okay. Oh, Denise said the Japanese yield went to 0.7. Yeah, yeah. Well, remember they said that they're cool with that popping to 1. But that is, you know, news. I don't mean to like understate that. And a change in policy is the whole point of tracking monetary policy. We want to see the changes in policy. But the bigger thing is, will it really matter that they move from negative to zero? I think that's all they're doing. So they move to zero for the next 10 years instead of negative zero point 0.1. So I think they just maybe, and they could even move it to zero point 0.1. So let's say they raise interest rates in Japan a couple of times next year, all the way to 0.1. I think they're doing it mostly, to make the math work, so to speak, because it's weird to have negative interest rates. It is weird. So I think that's all they would do is go to 0 or zero point 0.1, and that's where we're going to be for the next 10 years. Or, when I say 10 years, it's like, well, for some obscure amount of time, and we would worry about other things along the way. Like, our question as traders and investors is, if the Bank of Japan did raise interest rates all the way to zero and continued yield curve control, will the yen still be weakening? And yeah, probably. So otherwise, we'll adjust. All right. So, anyways, let's take a look. The market's still very long oil. I'm actually short. How am I doing? Yeah. I'm actually short only because there was a triple top, and just kind of, it's a trade. Don't judge me. Don't judge me. But anyways, investors are still long oil, but you might see that it's a triple top at a monthly projected top. So it's a triple top at a projected top. So, anyways, but what we want to track is not just strong versus weak. Okay. We also want to track the flow of capital. So, yes, lots of people are long oil, for example, or institutions. But what we can do is look at the change, and money has gone into oil. Okay. 41,000 new contracts versus less shorts. Okay, cool. But remember, this is about a week old. Even though this is updated on Friday, this information was from Tuesday. So we already knew that oil has skyrocketed up to a top. And so I think maybe on the short run, there could be profit taking. And that's what I'm doing. Short term short, but then I'd like to get back long. It looks like institutional investors want to be long. Money has also moved into the 10-year T note. Okay. But look at how many are short. It's just like, whoa, whoa. Anyway, so yen, say, and then all of a sudden you look at it like, well, the flow of capital actually is pretty meager, right? Doesn't look like a lot of trading going on at all. Okay, like when you look at the stock market, this S&P 500, money is coming out of both long and short positions, with a slight emphasis on short. 60% are short, 40% are long. I'm waiting for this to change direction. This week we have CPI, and that is going to instantly tell the market whether they should believe, based on their belief system, whether there's more rate hikes or not from the Fed. So this Wednesday, CPI, the following Wednesday is the Fed meeting. And I believe we're either soon going to be in the blackout period, or we are in the blackout period where there's no more Fed speeches. Okay. Oh, Johnny's like, cut cut his cable months ago. Yeah, sleep better. Yeah, we did that actually 10 years ago, but I use I use the online version. So like behind me, even though I quote unquote don't watch TV, I think here I got CNBC. This is BBC. This is ABC News in Australia. There's Bloomberg. And then I got CBC on this morning, eh? CBC. Yeah. But sometimes I have Al Jazeera up there just because I want different points of view. Yeah. But you notice I never have the sound on? Yeah. I just find listening is terrible, eh, Johnny? It'd be cool if you can get cable TV for half price with no sound. Would that be great? You're like, well, how are you going to watch? I don't even know a name of a talk show anymore. I was going to say Oprah. I'm like, I don't think she's been on TV for 10 years. I don't know. Maury? I don't know. Ellen, is Alan still on? Yeah. Anyways, so yeah, but anywho, so look at this. It looks like a lot of capital is just really coming out of the market still, huh? Less bulls, less bears. You see how thin the herd is? Well, this is important, I think, because some people, maybe it's justified. I'm not here to say right or wrong, but some people I think are freaking out because the markets have been down a couple of weeks. Okay. But what's actually happening based on the flow of capital? The market's going neutral, I think. And what are they doing? They're waiting for the Fed meeting. And then when the Fed comes out and says, hey, we didn't raise interest rates, how do you think the market's going to feel then? Money, where's the money going to go? Long or short? Isn't that what we're supposed to be doing as intellectual investors? By the way, I own intellectualinvestors.com, so don't start googling it and try to buy it. I know it's good. Yeah. Yeah, we're trying to be intellectual investors. We're like, we want to follow the flow of money, right? Right now, the flow's out. So maybe you shouldn't be going heavy into the market. But once this information comes out, then we can actually then track the flow. What else happens next Wednesday that we should care about? Yeah, the Fed meeting. But what about the Fed meeting? I've been saying since January that the September meeting, they're not going to raise. Jim's right. The SEP. Yeah, that's right. Denise is right. The dot plot. Yep. You're like, oh, the dot plot. Where do I get that information line? Oh, well, let's go over here. Let me get it for you. Here's the Fed's dot plot. Oh, it's so nice. Isn't it nice to be informed? You're like, wait, where do you get that? Oh, right here. Oh, you're like, oh, that's nice. It's easy to read. Yeah, you're welcome. So we have cuts next year. And what if they don't change? Or what if this moves up? Meaning no cut next year. You can see third quarter of next year, the Fed expects a cut. This is the Fed's opinion. This is the summary. This is the dot plot done more beautifully. If you've looked at the dot plot, you're like, I don't know how to read this. I very often show people like, here's the dot plot, and they're like, what does that mean? Right. So anyway, so this takes the dot plot and it puts it in a way that a human mind can actually read it. And it's the average, of course. And on average, the members of the Federal Open Market Committee, which is what, 15, 16 people by the time you put in the board of governors and all that. On average, they say, the FOMC say interest rates will come down in the third quarter of 2024. Huh. What if that goes up? Huh. That's what matters. That's what matters. What percentage of retail traders are going to have that data? Zippity doo dah, zippity a. Yeah. By the way, this is New Zealand for next year. Whoa. So some cuts next year out of the United States is what's priced in the market right now. This little cut, see, third quarter, fourth quarter, cut. That's what this shows, right? So because these are averages, what's priced in, so when you hear rate cuts are priced into the market, what that means is negative 0.42 interest rate. Interest rates will come down negative 4.2. And you're like, well, how does that work? You're like, no, because they're averages. So what's being priced in is that the Fed cuts interest rates twice next year. That's all it means. So basically 0.5%. But look what New Zealand is telling us. 2%, almost 2%, 1.75 or more, 1.84%. So might as well just say 2% cuts. And that's what New Zealand has told us lately. Look at, right? The rise over run is very negative next year. So QuantBox says, hey, your bias, dovish versus hawkish, maybe you should be dovish on Kiwi. Oh, well, that's nice. Yeah, thank you, QuantBox. Cool, right? For sure. And look at this, euro and yen. Well, maybe this needs to be updated, but even then, if it goes from negative 0.1 to 0, or to negative 0.1 to 0.1, it's so tiny, you can't even really put it on this thing. So maybe it doesn't change much. And why is euro negative if everybody expects them to jack up interest rates? They don't give us any guidance at all. See, all of this is made by information given to us by the central banks themselves. It's not opinion. It's not my opinion. So thanks for nothing, ECB, because that's what they give you. Nothing. So anyways, let's look at that scatter plot. And everything is bad. Nothing on this is good. Oh, you're like, well, gold is up. Well, at least I own gold. Remember, gold was bouncing on my 50% pullback. The one thing that's working out, or maybe you're short euro pound. Well, I wouldn't do that. But anyways, the yens are down somewhat. Okay. Now, here's the other thing. I do want the US dollar to weaken. I do want the stock market to go up, right? So even though it's not what has been expected, I expect things to change in the future. And so QuantBox doesn't think forward, it does quantitative analysis. So yes, we have historic data and compute that into seasonality. So that is forward guidance, if you will. But QuantBox is measuring what's actual. Scatter plot is just showing you what is happening now. Who cares, right? And then comparing that to the longer term expectations, right? But then I'm, as a human being with actual intelligence, not artificial, I don't think, I'm trying to take all this information and say, okay, well, what's the next step? Okay, there's what there is, what there should be, and where we're going to go. And I'm like, well, I think dollar's going to weaken, and I think the stock market's going to go up. And then so I look at bullish unexpected, and I'm like, okay, I'm long gold, so that's working. I'm long the stock market. All right, Nasy's up, S&P 500 is up, FTSE is up, DAX is up. Okay, and I want the yen to be weak, and I want the dollar to be weak. Well, Aussie yen is up. Oh, look, there's the Dow. Pound dollar is up. Kiwi dollar is up. Aussie dollar is up. I'm like, well, actually, okay. Things are pretty good. And I want the yield on the 10-year. I want the yield on the 10-year to come down. and it's zero, so not up is okay. Japanese stock market is one of, the only thing down for out of the stock markets. Well, there you go. They had that negative news. Oil's down, which I'm actually short right now, so hopefully that continues. So you're like, huh. All right, not bad, actually. Not bad. Because I'm trying to get this to be more expected. I want Aussie yen to be over here. I want pound dollar to be over here. I want S&P 500 to be over here. I want bullish and expected. So that's the game I'm playing right now. This shift. And it takes patience and discipline because we knew months ago that we're going to enter a 5-week period. 5 weeks in which this transition could occur. So I'm trying to be patient through this 5-week period. So we'll see. It's unexpected, but I expect the unexpected. So we'll see if I can survive it. Okay, 10-year T-note though, the yields are way, way up, and I need them to come down. So I'm really over the weekend. I was busy all weekend, but one of the things on my mind constantly is, is the 10-year yield going to go to 5? Because if so, I need to not be as exposed to that. Because as I said, if this is going up, it's not benefiting me. So I have to I need to rotate out, for example. Same thing with the stock market. If I think the stock market's going to fall in the next couple of weeks, I need to rotate out of some risk and rotate into a little more safety. So these are big decisions, right? Like they're truly big decisions. So these things are important. Oil is way up right now, but at resistance, and I think we can take a look at that. Okay, yen pairs mostly positive over the last week. Yeah, Nazi down quite a bit. S&P 500 down quite a bit. Notice the difference. It's this that I'm looking at. There's almost double the volatility. This is like a measure of beta. So both are markets, right? The market. Okay. Well, so the market's down, and you can see Nasdaq's down almost double the S&P 500 over the last 7 days. What does that mean? Well, there's the same forces are at play, but the Nasdaq moved almost twice as much volatility. So when I say I might need to rotate out of some risk, if I thought this was going to continue and that we were going to have 2 or 3 months of the stock market adjusting, or let's say you thought the stock market was going to come down 10%. Well, like which stock market? Nasdaq might be down 10%, S&P 500 would be down 5%. So shouldn't I, if I thought that was likely, shouldn't I move money out of Nasdaq and into the S&P 500? I still have the exposure to risk, but half as much risk, but I'm still own the market. And then you're like, well, what about the Dow? Now the Dow for the week is only down 0.5%, half as much as the S&P 500. So then to take it further, say, well, I want to be invested, but I think there's a big pullback coming. I'm worried. I think the Fed's going to have to raise interest rates 2 more times and never cut next year. We'll rotate money out of NASDAQ into the Dow. Okay. And not only have I done that, but I have a put on the Dow. So if the Dow falls, I make a little money to offset my cash exposure to the Dow. So almost no risk now. So I get to zero, but I still own the market. And that would be wicked smart, as we say at Harvard. Yeah. So anyways, cool. So that's how you do that. And so let's look at a chart to appease the technical gods. Oh, just what I want to make a comment on the yen. So, like I said, um, commentary this morning was freaking out um, about the yens, and the way I look at things, like nothing really changed. So I still am looking for risk on. Let me move that over there. I'm still looking for risk on. And yeah, I have concerns, of course. And I know where my risk is. It's Wednesday and then the following Wednesday. But technically, this is just, I mean, it's not lovely, but it's not working. Okay. So we're just slowly climbing. Of course, the risk is it collapses off of a top here. Okay. But it doesn't look like it wants to do that. So the yens are still generally up, in my humble opinion, or at least they're not down. So this is what I planned out yesterday. And then again this morning, commentary was freaking out that everything has changed in Japan. And then I look at this and I'm like, no, nothing's changed actually. But thank you. Thank you for the hype. But my research tells me up, and I look at this candle, and Bloomberg's telling me the yen pairs are down, and I look at them like, not my yen pairs. So Aussie yen is up, and Aussie is a dog. Well, there's also some rumor about China doing better. Now, remember the narrative, everything was horrible. Now everything's good. How do people keep up with this, huh? It's all, remember 4 weeks ago, everything was awesome. There was going to be no recession. And then suddenly, oh my God, everything's bad. And now everything's good again. Think, I don't know how to keep up with it. Oh my God, sky is falling, right? Anyway, so here's what we looked at last week with this one. I don't love Kiwi, as I just showed you, but what we looked at last week is this is killer support. And so here's this terrible news. The yen was here Friday and closed a little bit low. We gapped down, hit support, went straight back up. So there's the big, crazy, everything is over news related to what Uade said over the weekend, that they might go from negative zero point 0.1 to zero, maybe by the end of the year. Oh, well, somebody bought it at support. It's making money. Good for them. Okay. Euro yen. Okay. It moved quite a bit. It gapped down for sure. Hit support. Okay. Hit support and stopped. So I don't know if we're on our way down here, but on the daily, it's mediocre. But you could argue that that's support. It's what happens next that matters. And okay. Swissy, let me zoom in here. Okay. Again, not a great trade setup, but currently, is the market freaking out, is what I'm trying to point to. And in this scenario, those that short there target here, and it dropped and people took profit or went long. We don't even know. There were orders sitting there. So if you're a bear though, and you're like, everything's changed, you want to sell off those moving averages. Okay. It might be a head fake though. Okay. And Beast, yeah, it made a lower low. So again, maybe this was just volatility and we work our way up. If you're going to be a pure technician, you want to sell right in here. Okay. If you're gonna buy the yens and be risk off today, that's your trade plan. Johnny's like, yeah, news propaganda and manipulation. But you know what I find strange, Johnny, is like, to what end? Like, for what purpose? Like, there's almost like no agenda behind it. It's just, it's just a guy standing on the beach going, "This is the worst hurricane in history." And you're like, but that's what you said about the other hurricane. Right? All of a sudden, you're like, it's just hype, but like without an agenda, it's strange, right? It's just hype for hype's sake. Um, but whatever. So technically, depending on, if you want to bring the yens down in this particular, and this would mean your outlook for the stock market, your outlook for the market in general is risk off. So if you're a risk off player, yeah, get ready to short. You probably got something to do this morning. Okay. So I'll show how to do that, and then I think we'll call it a day. I'm going to highlight this area here. So the purple box. So that includes the central pivot point, the 4-hour 21, 4-hour 55 zone. Okay. Drop into what, a 5-minute chart? And maybe you have a short somewhere in there at some point. Some people will just trade the 5-8 cross and bring it down. Other people will wait for the 21.55 to cross down. So what'll happen is you'll get a move like this. Um, but the most important thing is you're ready, willing, and able as a bear to get short there. And it's not the 5-minute chart, it's the 4-hour chart that set that up. Okay. You have a long-term bias, bearish, risk off. It's not even bearish, just risk off. It's your sentiment based on your research. And then we've had the news and all that kind of stuff, but it shouldn't change anything. You were a bear before, now you're a bear again. That's what fundamentals are about. News is news. News doesn't change much, okay? Or anything, actually, just adds volatility. So going back, if you're a risk off sentiment investor, this is your theme, your thematic investment strategy, risk off. Okay, great. Now we look at a 4-hour chart. The yens have rallied up to a 4-hour resistance zone using moving averages and pivot points and all that kind of stuff, which fits your narrative. And so now you're using technical analysis on a smaller time frame to essentially sell between the 21 and 55 moving averages on a 4-hour chart. So it might be something that you're doing the next 2, 3, 4 days, depending if the trend shows up or not. Nice. Yeah, cool. Yeah. So that's it. So I will see you later in the morning, I'm sure. Peace on earth. May the pips be with you. May your profits be above average. Have a wonderful trading week. See you later.